get on with our day. But I'd like to call a meeting for the OPEB Trust Board of October 24th, 2024 to order. If you could have a roll call, please.
Thank you. I'm only going to roll call Trust Board members. We don't have a committee rules to worry about today, so we're going to start with Director Cochran, who is right next to me. And is going to say,
oh, look, thought he was looking for him. Looking for the other.
I was looking for Barbara. I thought maybe she
was absent. Judice?
Here.
Roseball?
Here for a while.
Hernandez? Was absent. Maskin?
Here.
Bordoni?
Yeah.
He left? Okay. Absent. Vice Chair Barr? Chair Rabbit?
Here.
And we have ex officio Joe Waters. Thank you.
All right. Moving on quickly then, we have the minutes on the consent calendar. It's the only item on the consent calendar from our meeting of March 21st. Any questions, comments, or concerns? If not, can I get a motion to approve?
So moved.
So we have a motion and a second. We do voice votes?
Yes.
So on the consent calendar, all those in favor, please say aye.
Aye.
Aye. Is there anyone opposed? Please say no. Hearing no opposition, it does pass unanimously with all present. Moving on then to the OPEB Retirement Investment Trust Board Education Informational Item. And Andrew Brown is here from PFMAM.
That's correct. Yeah. It's good to be back here. Retirement Trust Board Committee. I am here to give you an update on the educational topic that I think we do on a semi-annual basis. Am I a little too loud? Okay. Oh, you're crunchy. I thought you said I was crunchy. Okay. Good deal. I understand that Monique was here maybe earlier in the day, so she's already provided the economic. Oh. Oh. Well, I'm going to pass on the economic overview unless you have some specific questions. Today's topic, Alice and I put our heads together a couple weeks ago in terms of what would be a relevant topic. And despite my motivation to maybe talk about the investment implications of the outcomes of the election coming up here in 2 weeks, she did her best job to talk me off that career ledge. And instead, we're going to broach a topic that I think is pretty important. I mean, it's not something that we think about too frequently, at least client and long-term client and investment manager, but how we add value. And what are some of the things that you should be thinking about in terms of evaluating us, in terms of whether we're adding value or not. So adding value is how we're going to, how we add value is the topic that we're going to look at. And I'm going to be starting on page 1. And, my biggest challenge in terms of putting this presentation together was really, I'm still kind of a newbie at PFM Asset Management. I've celebrated my 10th month here. It started on January 1 officially. So I'm still trying to learn all the various exhibits that, sales and marketing and client servicing present and produce. So this presentation is kind of a hodgepodge of some sales and marketing slides, some client servicing slides, and really most of the slides really come from item number 5 that we're going to be looking at, your actual quarter or fiscal year end investment report. So with that, starting on page 1, we call it Pillars of a Portfolio Management Relationship today. I would imagine this is probably something that Jim Link might have presented to the board way back when, 18 years ago. And what this is really comes from one of our slide decks, and it starts off by really describing some of the things or some of the areas that a portfolio manager or a portfolio management team would seek to do to add value for a plan. And really what formulates the presentation in my mind are going to be the first and second column. The second column there, portfolio management, that's going to be the meat of the presentation, and probably about 75% of the presentation is going to focus on portfolio management decisions like active and passive, manager selection, asset allocation. But what I'm going to do is I'm going to start on the first column, strategic portfolio planning and design. And here, if it's day 1 or year 16, It really starts off by us sitting down with the client and figuring out what the goals and objectives are, identifying risk appetite, figuring out what the liquidity requirements are, and assessing if any type of customization is necessary within the plan. Within an OPEB plan, more often than not, the goal and objective is really a quantitative number, right? It's something that we get from the actuary, Foster and Foster, and we then try to, if you turn to page 3, we try to come up with an asset allocation policy that dovetails with the actuarial investment target. And so on an annual basis, the exhibit that you see on page 3 is something that I provide to staff to make sure that we are consistently in line with what the actuary is expecting us to target in terms of expected return. And of course, we're also focused on the risk factors. We look at it from 2 horizons there at the bottom of the page. We look at it from a short-term horizon, just to kind of, think about it from a sanity check standpoint, a 5-year horizon. But then at the bottom of the page is really the number that the actuary would want to see, and that would be the long-term expected rate of return. So this would certainly be a key part of the plan design and the strategic planning focus of the plan. For the remainder of the presentation, I'm really kind of focused on that middle column that we looked at on page 1, the portfolio management decisions. And so I'd like to ask you to go to page 5. And on page 5, I start off with a quick discussion on active and passive exposure in the plan. And really, active and passive management helps us maximize the efficiency and really saving costs on plan expenses. And so I don't necessarily want to assume that everybody has a complete understanding of active and passive. So just very quickly, if I say passive, I'm referring to I'm utilizing an index fund to invest in a certain asset class within the plan. Index funds seek to replicate a certain underlying benchmark target at a low expense level. When I say active, what I'm referring to is we're investing in a manager who we expect to outperform a certain index target. Of course, with the outperformance expectation, there's going to be a higher investment management fee associated with it. So we want to make sure that the manager is outperforming the benchmark after fees and expenses. What I've done on this page is I've highlighted in green rows that are associated with what we would say passive management, index-based management. Let me give you some quick statistics here. 59% of the portfolio is passive. The entire domestic equity portion of the portfolio is passive. 70% of the international equity portion of the portfolio is passive. 30% then would be active. But conversely, on the fixed income side, 15% of the portfolio is passive and 85% is active. So the read through here would be, we think that there are opportunities, certainly on the fixed income side, to add value. International equity, we at least go into the decision thinking that, we have a lean towards active management. And then for domestic equity, probably not. Low probability over the long term of adding value through active management. On page 6, one of kind of the neat slides I found in the library for client servicing is historically how is PFM, certainly way before my time starting here, how has PFM explored the notion of active and passive through the portfolios. So you'll see 3 colored lines here on page 6. The green colored line would be fixed income, the yellow is international equities, and blue is domestic equity. If you see a line towards the bottom portion of the x-axis, that would be indicative of exposure, high active exposure, low passive exposure to a portfolio investment. And then towards the higher end of the y-axis, you would see a portfolio asset class that would be much more passive in nature. And you can see the ratios that I gave a second ago have been pretty much followed throughout at least the last 18 years of our history. We come into the portfolio management challenge with a strong bent towards active management on fixed income. International equity kind of ranges over time, and domestic equity certainly a lean towards passive. And so by now you're thinking, all right, well, how have you guys done? So with that, turn to page 7. So page 7 is the same as page 5, and what this is your investment performance report for the period ending June 30th. So I figured the best way to do this, since I'm not on a Zoom call and I can't run my cursor over a certain portion of this exhibit, is I highlighted a couple fields that I wanted to draw your attention to. And I thought it would be best to maybe work our way from the bottom up. And so this page covers our investment performance for a variety of periods of time. And so this is all ending June 30th. And the column headers at the top cover the quarter, the fiscal year to date, the 1, 3, 5, 7, 10-year periods of time, and then inception to date to round out the column headers. And so going from bottom up, the fixed income portion is the first fixed income segment is at the bottom of the page. And so I highlighted a couple fields in the 3-year segment. And the first thing you probably notice is that, well, everything in the 3-year annualized period for fixed income has a minus sign in front of it. In other words, fixed income has a 3-year annualized rate of return. That's a negative rate of return. And so this brings up the notion of the investment asset classes that we invest in, stocks and bonds. They go up in value, and there's periods of time when they go down in value. Just because an asset class is in the red, so to speak, doesn't mean we can't seek to add value. Unfortunately, the way we add value is losing less than the market. And I know that's not always appealing to investors. It's not appealing to me. But that is one way to add value. And I guess I should come up with a better word than pleased, but, I'm pleased that we've lost less than the market, at least over the last 3 years by about 0.5%. I think it's a better story if we look at the 5, the 7, and 10-year period of time for fixed income, where A, they're in the black, and B, handily outperforming the benchmark. So in terms of coming into the notion of, hey, active managers on the fixed income side, I think it's clear that we've added value on this in this asset class segment. It's a little bit more mixed, though, on the international segment right above it. In the middle part of the page, we have some of our international equity managers, and I started highlighting there in the fiscal year to date period of time, which would be the 12-month period of time ending June. And you look at the green shaded region, Goldman Sachs GQG. I wish it was always this easy to find a manager that was going to, deliver 29.3% in the benchmarks, up 11.6%. I might get lunch today. That would be good. But you look at the 2 rows above it, right? Harding and Loevner and J.O. Hambro, both are underperforming over the last 12 months. And that underperformance is significant. And that underperformance is certainly dragging down the historical numbers for the international equity segment. So I highlight this because this is one area where we can seek to add value, and not by finding managers that underperform, but by our manager research group. And here I need to rely on my manager research group to vet, review, and figure out what the heck's going on with these 2 managers. I mean, is it just a short-term blip of underperformance, and they will right the ship? Such that what they've generated over the last 10 years, I mean, if you go to the 10-year annualized column, both of them up about 1% annualized over a 10-year period of time, which is fabulous. But that hasn't helped us over the last 12 months. So here's where I really rely on my team, the manager research group, to review and analyze and figure out, has this team lost their edge, or is it just a short-term blip? So this is one area that we seek to add value. And well, frankly speaking, international equity is a little bit mixed. If we look at the blue bar at the middle part of the page, we have outperformed over the 7 and 10-year periods of time. But frankly speaking, I'd feel better if the numbers were a little bit larger. Let me have you turn to page 9 if I could, and we'll talk a little bit about asset allocation. Asset allocation over the long haul is going to be the largest area for potentially us adding value for the plan returns. And so, having a 10-month track record with PFM, I don't know what an average year looks like, but when we look at this page, what it does capture is the asset allocation decisions that we've made over a 12-month period of time. And it kind of feels like maybe a semi-average year, right? I mean, you see the yellow dots here, which would represent times of the last 12 months where we've reduced risk. So we've sold, in this case, equities, and reinvested into fixed income. And then you see the blue dot there, where at one point in August of last year, we added some risk going to a new asset class. So, over the course of the year, we'll probably make 3 or 4 modest asset allocation changes. We won't do too many dramatic moves. Not all years are like this, though. Turn the page, please, to the next page, where 2020 was certainly one of those periods of time where there was a whole lot of opportunity, at least on paper, to add value, and there was a whole lot of opportunity to run into that burning building and maybe not come out. I mean, it was a very volatile period of time. So what we have here on page 10 is at the top of the page, we have just the S&P 500 price movement for that 12-month period of time. And really, the far left-hand side of the top part of the exhibit doesn't really do a 36% decline in the market justice. But that's exactly what we faced in the first 3 months of 2020. And so that does, though, on the surface, give one an opportunity. And so that's kind of what you see at the bottom of the page, managing risk and capturing opportunity. And how does a manager toggle back and forth between those two paradigms? Because certainly in February and March, we don't know what the future holds. We don't have a vaccine. We don't get the vaccine until the fourth quarter of this year. We do get $7 trillion in quote unquote stimulus or money to get us over the bridge. But how do we manage in that environment? And so at the bottom of the page, you can see how we do incremental. Typically, we'll do incremental asset allocation shifts. Nothing grand, bold. I mean, we don't attempt to call the bottom because, the market goes down 15% by February. Guess what? It has another 15 to 20% to go, and we don't know that. But we'll do incremental moves to try to take advantage of some opportunities because we do, fortunately, have a long-term time horizon. So managing risk, capturing opportunities, some years do offer those periods of opportunities. And certainly the question of how did we do is captured on page 11, the next page, where I highlighted at the top of the page calendar year 2020 and calendar year 2021. And in both years, actually, when we look back in the rearview mirror, they were two of our strongest years on an absolute basis, 17.2% in 2020 total return and 13.6% in 2021, and handily ahead of our benchmark targets. So sometimes in downward moving markets, that does give us that opportunity to proverbially buy low. I wanted to do just a couple quick hits in terms of areas that we add value. So the next couple of slides, I'll maybe just do a quick flyover on page 12. Alternative managers, and the title that I put at the top of the page, risk and or reward. One of the benefits that the alternative segment, and this was a newly adopted asset class probably about 3 years ago. Exactly 3 years ago. It does give us the opportunity to invest in an asset class that has low correlation with the 80 to 85% that's invested in traditional fixed income and equities. So on the one hand, we're reducing risk, but I know most of us, including myself, want to see an absolute return that is notable and beneficial. And so what I did was in the far right-hand column, I highlighted in yellow the inception to date return. And so we have 3 buckets that we invest in. The first one would be private equity. And if you toggle to the far right-hand side, you can see private equity for roughly the 3-year period that we've been invested in, 20.1%. So on the surface, we would say, we've added some value here. If we had to compare, though, and we think about the last 3 years for the S&P 500, maybe 20.1% has only kept up with the S&P 500. I mean, it's been a spectacular year for the S&P, or spectacular 3-year run for the S&P 500. So 20.1%, I'm pleased to show it to you. It's certainly outperformed international equity, but I don't think it's outperformed domestic equity. So maybe a mixed result here. Private debt in the middle section, 10.4% annualized since inception. Check that box on value added. I mean, remember on that fixed income exhibit where I showed you the minus sign on the 3-year annualized period? Well, there's no minus sign in front of the 10.4 number. So certainly private debt has been one of the strongest areas within the alternative segment. But the real assets, the real estate portion for the alternatives, disappointing so far at a -1%. But that which is down doesn't always stay down. And so we were looking at the opportunities within alternatives on real estate to potentially buy low. So I would have a lean towards, yes, our alternative managers have added value over the period of time. On page 13, I think it's certainly worth mentioning that, yes, we try to add value, but we try to minimize areas that would detract from value. Fees and expenses is certainly one of those areas. And so for staff, we prepare this exhibit on a quarterly basis to show the embedded expense ratio for our managers that we invest in. And through June 30th, it is at 31 basis points. At roughly about $134 million of plan assets. That comes to about 16.5 basis points. So all in, our expenses are right around 47, 48 basis points. So to the extent that we can reduce that and make it lower, then yeah, that would be one way to add value or not have fees detract from value. And then finally on page 14, the historical track record. We have a blended benchmark that we base our investments against, a reference portfolio. And I am pleased to say that and I'm part of the we for at least 6 months of this, the 5, the 7, the 10-year period of time, as well as inception to date, all handily in front of our blended benchmark. So I think that this would be the exhibit that I would point to if you had to say, well, where does the rubber hit the road? I think it hits it here. So in terms of a presentation, if I was giving this presentation in the first maybe 20 years of my career, I'd probably put the mic, go red on the mic and move on to item 5. But truly, I don't think I've answered the question of how do you add value. I think I answered the question about have we added value, but the how we add value is really found on pages 16 and 17. And pages 16 and 17 give the roster of our investment personnel, both the investment committee as well as the subcommittees that comprise our team membership. And we're a knowledge-based organization. We don't build iPhones or build bridges, but we certainly do build portfolios. And the portfolios that we build are just the collective knowledge and inner workings of all of our teammates that you see here on page 16 and 17. And to the extent that we can get all of the people, all these smart people on the same page to share ideas and push each other to be better than they were the day before and to eliminate distractions and dysfunctions, we'll be adding value. And that's exactly how we would add value. And so with that, let me pause and see if you have any questions.
Anyone have any questions for Andrew? No? Thank you very much for that, Andrew. Shall we move on to the have we already done that? Are we on 4 and 5 combined?
Oh, well.
That was just 4. So how about to receive the OPEB Trust Investment Advisors Investment Performance Report?
Okay, I'm going to do a couple of highlights on a few of the pages. I think I picked 5 or 6, but if I've missed a page that any of the board members wants me to revisit, raise your hand and just let me know. I'm going to start on page 2.3. On 2.3, we start from just a total fund perspective, and I guess you've already seen this page 2 to 3 times already, but the total fund for the last quarter, this would be the April, May, June ending period, 1.46% return, basically in line with the blended benchmark of 1.44%. For the fiscal year ending period, though, 13.09%. Which is a bit ahead of the benchmark at 11.79%. So pleased to show you both the absolute return over this 12-month period of time, as well as the relative outperformance on the benchmark. On page 2.4, you've seen this page twice now. Most of that 13.09% really came from domestic equities. Domestic equities up over 22% over the last 12 months. International, not too shabby at 11.5%, but you'd be surprised at how many clients sort of say, boy, it'd be really good if we would have had more in domestic rather than international. But, 11.5 on international is not too bad. Fixed income, 4.5%, certainly less than 11 and less than 22. But when you look at that 10-year annualized number of 1.8%, getting 4.5% over a 12-month period of time, I will take that based on our last 12 months. I wanted to just go over maybe 2.8. Slide 2.8 has the account reconciliation from a financial perspective. So this is less percentages and more just absolute dollars. The quarter, year to date, and 1 year periods of time are depicted on this page. And 13.09% is a good number to generate. It feels maybe a little bit better when you see the $15 million of return on investment generated over this period of time. Contributions, distributions, not exactly equal to each other. A little bit more in terms of distributions, $10.7 million over this period of time, $8.1 million in terms of contributions for the 12-month period of time. Page 2.9, please. We recognize internally what the 800-pound gorilla does. Don't always show it to clients, but we know that the board wants to see what CalPERS does. The third column over from the left would be the 1 year period ending June. And total fund return would be at the top line. That would be our return of 13.09%. The third row would be the CalPERS Surbit Fund 1 at 11.03%. We have bracketed numbers in terms of the peer universe of comparisons. 13.09 would dovetail to a 26th percentile performance, so kind of in the top 25 percentile almost. And then CalPERS would have been right around the median at 56th percentile. So we don't get too cocky when we outperform CalPERS, but we might smile a little bit. Page 2.11 or 2.11 just captures the blended benchmark target in the upper left-hand corner where we're currently allocated to. And currently our allocation is at 13% in alternatives, 28.5% to fixed income, and then that would be 58.5% to domestic equities and international equities. Yes, sir.
So on that page, what is it, 2.11?
Yep. How
are the mandates determined? And who determines them?
The mandates would be determined on an annual basis. It could be modified if we felt that there was an asset class that we wanted to introduce that would impact the fundamental underlying nature of this. If we potentially thought that, good grief, equities have generated a 15% annualized rate of return, we think it's in the best interest of the OPEB plan to maybe, by policy, take 5% off the table on equities and put it into fixed income because based on our assumptions, we think fixed incomes will generate this, equities will generate this. So that's certainly one area or one dynamic that could change this. Expected rate of return, that could change it. If for some reason our actuarial assumptions for one asset class was to be reduced or increased, we might change the underlying composition or recommend the underlying composition to be changed.
Okay, so you determine the mandate.
I would call it would be interaction.
Okay.
You guys do. It's a board policy.
All right.
Yeah, it's your policy.
I think he's referring to the benchmark.
Okay, yeah. Okay, I think.
And these are the benchmarks.
Yeah.
Not even
What's the benchmarks?
Okay.
Okay.
Did I answer it?
I think so.
Okay.
Thanks.
The compliance certificate was just the final exhibit that I wanted to go through, and that's 3.1. And I guess I would draw your attention to the far right-hand column. Are we within range on the asset allocation policy? And Yes, from top to bottom.
So these are the allocations the board sets in its policy. And then what we try to do is we, over the years, different times, we've worked with PFM to come up with a benchmark so that they can judge how well they're doing against something that seems realistic. Mm-hmm. And the benchmark, sometimes we have gotten off, and we've moved on to new investment categories, but the benchmark has stayed with old ones. So it's been a little more dynamic lately. And it's essentially a way that we can quickly, as a group, look at them and say, are you doing as well as you should? Doing as well as sort of a person would. And this benchmark that we have now includes a number of the new classes that we didn't have those types of investments before. So now they're included in our benchmark. So if they do well in general, then we expect them to do well, or they won't look good compared to their benchmark.
Okay. Thanks, Ben. Thank you. Appreciate that.
Okay. Those are the exhibits that I wanted to discuss on item number 5. Any questions?
I do. Not a question, but this is my last OPEB meeting. So, very proud of this. Lots of work. But also, and all of your, and Barbara was here from the beginning.
I was.
Mm-hmm. Yeah.
I remember when it wasn't you, Joe.
Yeah, back at 2.1, 2.1 was it's not a fancy chart because it's been around since the beginning. So it looks the same as it did back then, except that we've added more lines to it, of course, because we've progressed and we've gone left to right on it also by raising money, which is what this whole board's job was to do. But when we began and everybody sat in the committee room, we were looking at the blue line on 2.1, and it was like, oh my gosh, Mount Everest. Mm-hmm. And we were down here with this much money. You can see how much little money we had from the beginning. And then of course 2008 came and we lost like 80, 40% back. So we had little and we had even little. And then, but the boards continued a good investment strategy, good investment advisors, following things, and then the district board committing them resources year after year after year has brought that line up, and you can see that line just climbing up. And now it's in the rarefied air because the district board has helped us out, us investors, by lowering the cost of the plans. So the reason that blue line, some of those early lines were so expensive is we had very, very, very expensive healthcare plans that this board was going to have to fund. And by reducing the cost of delivery of those plans, now we're way down here on the little pink one, or whatever color that looks pink to me. We're way down on the pink one. We almost have more. No, not quite. We're getting pretty close to having much right now that we would need in 10 years from now. Now, that pink liability number will change. Healthcare continues to go up scarily quickly, costs. So those liabilities will change, but you can see how much we've dropped the liabilities. And these different colored lines that you see each year are every other year, the actuarial report, which looks at the actuarial value of the benefits that we promised our employees. And the district has promised the employees that this board is in charge of funding and producing the funding for it. So, they've made a big difference. So the two things together is making a very, very successful trust. I'm definitely very proud of it. And in like 2 months, I'll be using it.
I was going to say. Now we know why.
Now you know. Yeah. It all comes back to like, well, what's good for the goose? Yeah.
Since we're looking at charts, one of the first charts you showed about the overall fund performance, by year, 5 years, since inception. What you need to do is you need to look at those returns since inception, mm-hmm. and then ask your HU trustees during that same time period, what did you invest?
You're relentless.
We knew you were going
to because that's a huge part of the problem. They bet on the guys from Vegas. They were all men, and they were from Las Vegas. And that should have been your first warning. Exactly. That's who those trustees hired, your predecessor. And so I just want to point out that that's a fair comparison to make, because a lot of the problem was they were giving away benefits, but almost a bigger problem was they were reckless in hiring an investment advisor. And you cannot emphasize the importance of hiring someone who is knowledgeable, respectful of your goals, and has a low fee structure. I'll just leave it at that.
And so we're going to let you bring that up at negotiations.
I'll gladly bring it up
With
time
the
and time
charts,
again.
with the charts.
I'll send more letters to the trustees.
Yeah, with the charts.
No wonder Dennis left.
I might just add on that just so the board recalls that board is comprised of half management, which was half of 3 members of this board and 3 members of the EHU during that entire time. So it was a push.
If you want more history,
Yeah.
the 3 district trustees recommended this investment firm.
Yeah.
And the 3 union ones recommended the guys from Vegas. And in the spirit of compromise, they hired the guys from Vegas.
They could have agreed. They could have gone to deadline if they did. Anyway, I'm going to move on to why I raised my hand.
I'm impressed by the white suits.
One, like Barbara, I was here then, and I do want to. Joe does deserve to be proud of this, and Alice, great work. It was risky, and at the time, a decision could have been made to go to CalPERS.
Yes.
And I think Jerry,
I was here.
Jerry was here, and a decision, and there was a lot of confidence in the investment management firm, and in Joe and the staff, and the recommendation of everybody, and so I think you should feel very proud of it, and it's and congratulations on it.
And you all should. And there was what was really good about it is that the GASB changed the rules, and this board and since GASB doesn't have the authority to tell this board what to do, they could just tell you what you have to report. So you had to report this huge liability, that big blue line. You're going to report that on your financial statements, and pretty soon we're going to be underwater because that's going to be more money. They're going to assume we're spending more than we even have. So we got to do something. So that's when we started the trust. And when the board agreed to start the trust, David Miller had to create the trust document. We were at the very beginning of this. CalPERS wasn't in the business yet. They came in the next 2 years later, I think, a year and a half, maybe 2 years.
A couple of months later, they
A couple of months, okay. They came in later, so we had a couple choices and to start from. But then even later, when they were up and running, we didn't switch over to them because we were outperforming them, and that's why that chart exists. That that Andrew mentioned. We just want to keep showing you that if it ever gets to a point where we're not doing that, then maybe we got to throw the towel in and go with the big boys.
And as you pointed out, the market, we had a tough time in that first year with the market.
Did have it.
But
We had a very tough time.
you stayed through it, and it worked.
to do that.
Thank you.
So it's good. Okay. Any other? No question. Okay. No. Looks like you're at the end of that item. But I think you have to have a motion.
Motion to receive.
So motion to receive.
Second.
We have a motion and a second. We'll just do a voice vote.
Voice vote is fine.
All those in favor, please say aye.
Aye.
Is there anyone opposed? Please say no. Unanimous with all present. Now we're going to go on to 6. Alice?
Yes, thank you. I'll do these fairly quickly. These are last 3 for today, so I'll do them quickly. The first one, item 6, is for informational purposes, and it doesn't require an action. To just dovetail to what Joe had just mentioned, this is the GASB 75 report that requires public agencies to report their OPEB liabilities on the face of the balance sheet instead of in the past in their footnotes. For this, this will be used in the act for that will be presented to the board next week. If you turn to the second page, just to click in it, if you look at the box, this is what the impact to the statement of position will be reflected in the district's after at June 30th, 2024. So to the right, you'll see at 6/30/24, the open liability is about $190.6 million. We have about $128 million in market value, and therefore, the assets, therefore, the net open liability is $62.5 million, which is a 67% funded percentage. Worth noting, though, is that given the level of trust assets, the actual would do what they call kind of like a crossover test, meaning that because we have adequate assets through this whole cycle of their valuation to sufficiently cover all the plan benefits for every single retiree, we were able to, I think actuary was able to use the discount rate that we have set, which is the 6 3/4, without having to use a blended rate that included a low municipal bond rate. And you will see perhaps in other pension plans where they're not as in this position, they did have to use a blended lower rate, which then obviously increases their liability. So it's quite-
Everybody except board members.
No names of what plan might meet that criteria that forced to use the 4.5%.
So that concludes my report for this one. If anyone has any questions, I'm happy to.
I want to add
Sure.
one piece just to explain.
Can you?
If you looked last year, the total OPEB liability was 163 million, and then this time a year later, it's now 190 million. You know, and it's in the paragraph right below the blocks. It explains why that is, but just something to remember is that you never have enough money. You never.
Or you can't ever
Not in
be
this kind of
thin enough.
Cross the board.
You can't
Yeah,
ever be
because-
thin enough either.
Because
What's the sweet spot?
those actuaries come in here and boom, you know, you get the next report and they bump the whole thing up by $30 million. It's not like we got $30 million worth of employees just showed up last week and all of a sudden we would more. They went back and looked at everything and said, no, you know, the way the rates are going and the people are living longer and what else they say, they're not dying quick enough, you know, all these things. I mean, it's like, it's going to add up to this much.
Actuarial gain.
That's right. So even if we felt good last year at 72% funded, well, 70% funded, now we're 67, like we went down. And actually we had a great year. So but anyway, that's it. If you ever get to that point where, you guys remember back in 20 some years ago, plans were not contributing at all because everybody was super funded. Well, you don't stay super funded for long. You become unsuper funded really quickly, and the actuary can do it or the market could do it. In this case, the market didn't do it. Actually, things went well, but the actuary did it to us. So anyway.
Well, Joe, what you got to remember is most agencies are not doing OPEB.
You're right.
You know, period.
At all.
So someone's going to get stuck with that bill. I know when we started, we were thinking that, or at least I was thinking, and I think other board members, is that in a period of time, 20 years, 25 years, we might have enough in there where we don't have to contribute anything. I mean, that's what I was thinking. But if the feds come in and bounce you up when they,
You know, it's possible that could happen, but it's not likely that.
well, we'll always have to, the way it's set up, we'll always have to put something in.
And isn't that what got us in trouble in the beginning? Was that Sod was out there that we were fully funded and wouldn't have to worry.
And I mean, on pension side,
Right.
well, many years ago, there was a pension belief both in the CalPERS and the HPU.
Well, CalPERS, what,
Yeah.
72% funded, 70, I think right at 70.
So
So,
it deteriorates very quickly. Those superfunded time days do not last very fast, and they won't.
To your point, that I will say I was for 9 years a trustee of our retirement board, and we're 94% funded right now.
all right.
That's amazing.
Really?
And I got them to actually pay down UAL. That's the equivalent of $55 million since 15 and 19. We put it in a policy. But I was saying that we have the unfortunate thing is we're a 37 Act county, and we have ad hoc COLAs, which means you don't have a COLA because there is no such thing as excess earnings because of what we learned. The last COLA they gave out was 2008, right before the crash.
Oh, really?
Then they lost 30%. And even though there's been a year where we're over 100% funded, you know, now we're down, even in good times, now we're down to 94. There's never enough money. And if you're not putting it in the actuarial accounts, I mean, you don't have it.
No.
And David, your retirees get no COLAs?
Yeah, but we have Social Security.
Well, yeah. And that, you never know.
Vote early and vote often.
Don't be
We were, they were looking at doing it prospectively, but it's like, I mean, if you don't, it's going to be like 50 million a year, for us, which is a huge hit to payroll. And there's just no way. Tom Ford, who was our assessor way back when, tried to get it for like the older retirees that worked in the county hospital, like nurses that were getting, because their purchasing power has been 80. It was 80% in 2008, and I think the CPI since then has gone up 36%. So that's really a tough thing. Anyway, I digress. Allison, back to you.
Okay, the next item is item 7, and this is a staff recommendation that the trust board adopt a motion to ratify 2 district executive amendments that's related to the trust. The first one is the contract, the 8th amendment to the contract with PFM, and then the second one is the second amendment to the actual trust agreement. And the background on this is that, if you recall, I can't believe it was in 2021, but in December 2021, PFM Asset Management was acquired by U.S. Bank Asset Management. You might recall this. And at that time, PFM became a wholly owned subsidiary of U.S. Bank, and they've been operating kind of a separate entity and their own registered investment advisor. But just effective beginning of this month, October 1st, PFM's investment advisory client accounts were consolidated with U.S. Bank Asset Management. So upon the consolidation, PFM deregistered as their own RIA, their own registered investment advisor, and dissolved as a legal entity. But the PFM brand still continues as a division of U.S. BAM, or U.S. Bank Asset Management. So in talking with our district council, we thought the best thing for the district's benefits was to transfer both of these agreements to U.S. Bank Asset Management as a successor of PFM Asset Management. So that's what these 2 executed amendments do.
Great. Any questions for Alice on that?
Has that massive U.S. bank made any changes to your entity?
Massive bank changes, not massive changes, but small changes.
You're not forcing anything on your investment style.
No, on the investments, no, not at all. The changes we had, maybe a couple people announced early retirement.
One thing about this group is you used to have 2 separate entities, one that held the assets in trust and one that was your investment, manager. And now those entities are the same. And you reviewed that when it occurred, and you made a conscious decision that you were comfortable with it in this instance.
I move the item.
Second.
We have a motion and a second. Any public on any of these things?
We have no public comment on any of these. Well, I can tell you right now, unless you want to allow, I believe it's Jesslyn that's on the line that's listening to us. I definitely
just want to make sure. It says right here, public comment. So voice vote. All those in favor, please say aye.
Aye.
Is there anyone opposed? Please say no. Hearing no opposition, that does pass unanimously. On to item 8.
The last item, if you don't mind, this will be nice. Thank you. So the last item is every October we do an annual review, or we ask the board to do an annual review of the investment policy, the service providers, and the board's charter. And then we draft a annual report on behalf of this board to be presented at district board in November. So that's what this is. Let me just start with, because a lot of this is repetitive, but one thing I did wanted to show is if you go to page 2, which is the grid on top, this is kind of interesting in the sense that it lists from inception every fiscal year kind of a summary of what transpires. So you'll see the beginning balance to the left, how much the district contributed, and one big plus that this board has always done is always contribute at the minimum the actual determined contributions. So you can see those down the line there. So we contribute over close to $28 million into the trust in the last 16.5 years. And then the third column you see is the annual payments. And so these are all benefit payments leaving the trust. And that's a little bit right under $159 million for the last 16.5 years. And the next column you'll see the investment return. And this is where you see the fluctuation because it depends on what the market is doing. But overall, close to $80 million is what PFM has generated into the trust. So I think that's kind of a nice little thing just to look at. We reviewed the IPS, and we don't believe that we need to do any amendments, and it is in full compliance with the district's investment policy and trust agreement. Now jump into the annual review of the trust board services, the service providers. And as Dennis mentioned, there's really two. There's PFM as the investment manager, and then U.S. Bank as the trustee and custodian of the trust. I won't go into too much detail because we've gone through it and Andrew's gone through it, but I want to just highlight on page 3 in the middle, you'll see another grid, and this is kind of the money shot, right? Because this shows what PFM's performance at the net returns. That's after all the investment manager fees, as well as PFM's advisory and the U.S. Bank's custodial fees. And you can see the net return in the middle. And underneath that, I show what CRBT is. CRBT is the CalPERS trust fund, and you'll see in all years, even net of all funds, they have done well. We exceeded what CRBT has done. The next section is the pricing, and just to jump to it, if you turn to page 4, in the middle, it summarizes what the fees have been this last fiscal year, is about $616,000, and you can see the first 2 bullet points. Bullet points are what I call the hard fees. This is what we pay to PFM and U.S. Bank. It's about 19 basis points, $238,000. And then if you add in the estimated asset managers fees and expense ratios, about 31 basis points, or $379,000. And equates to about 50 basis points total fees, total. And just as a comparison, we do look at Morningstar's fee study, and their last one was done in 2023, and their average weighted expense ratio across all funds is about 36 basis points, varying between active funds at 59 basis points versus passive funds at 11 basis points. There are other few administrative costs that's not covered by the district's contract PFM, and these are things like the HRA administration fees, the actuarial fees, and the fiduciary liability insurance. And these are all encumbered and approved by the district in full compliance with the district's procurement policy. Finally, the customer service. As of March 31st, 2024, the combined OPEB plan assets of PFM and U.S. Bank is over almost $12 billion, covering 149 public agencies. Which you might notice which is a significant increase from last year, and that's because before it was PFM just by itself. So that's why. And you can kind of jot down below, you can see that they have various transportation agencies, including LA County Transit as well as MTC, and then other California clients, Sonoma County, Napa, etc. And I do want to say, for me as staff, PFM is wonderful to work with. They're very responsive to all our requests and inquiries. So, and I think based on the consolidation of PFM and U.S. Bank as one registered investment advisor, we suspect that will provide additional synergy, because prior they couldn't even talk to each other as different RIAs. Now they can actually legally talk to each other. So I think that would add a benefit. And finally, I want to just mention that last board meeting, this trust recommended to the district board to exercise the 2 additional 1-year terms on the contract with PFM. So now the contract is extended to February 28, 2026, which is about 1.5 years from now. But because this board only meets semi-annually, it would be timely to begin, thinking about options in advance of the contract end date. As detailed as we've gone through here, we've gone through their investment performance has been very good. The pricing has been reasonable and competitive, and the customer service has been very responsive to the district's needs. So it's based on these 3 performance criteria that should the trust board find PFM and U.S. Bank's performance satisfactory today, district staff will come back to you at the next meeting or maybe in the October meeting next year for a recommendation to renegotiate a new multi-year contract with PFM. Alternatively, should this trust board conclude that PFM may not be the best option for the district, you may request staff to issue a new RFP or consider other OPEB single and multi-employer investment programs. It won't take maybe 2 or 3 months to renegotiate a contract with PFM. However, RFP solicitation can take, up to a year to process. So I want to just keep that in mind. And also keep in mind that, if you do decide to, move away from PFM, there will probably new documents need to be amended or replaced, like the trust documents. And then also it's very, very likely that, you would have to, liquidate the assets currently in PFM and before you move into the new, trust, because they have their own investments that they would want you to go into.
What is the length of our current contract?
It was a
I didn't hear.
Sorry, it was a 5-year with 2 additional 1-year terms, so it's good till February of 2026.
Okay, do we need to I get really nervous to think that Joe's leaving, and I know Alice is still here, but do we need to make part of our recommendation to extend that contract with the new agency, the bank?
You would do that the next.
And
Yeah. Well, this is just a kind if you want us to just renegotiate with PFM, which we can under the procurement rules, as long as we do our due diligence, making sure that we get the best pricing, et cetera. Or you can choose for us to go do a full RFP.
I would
I don't
recommend
think
that.
I want to go to
Yeah,
That's a lot of work.
Well, it's not even that. We're exceeding the benchmarks. We're doing
Right,
very,
right.
very well. So if you want a winning horse, why try to swap horses in the race?
Absolutely.
You need to fall and get hurt.
So what do we have to do if it's good till 2026, what do we have to do to make it 4 years?
We just need your approval to let us renegotiate with PFM for a new multi-year agreement. So we could do what we typically did before is negotiate another 5-year with 2 option.
Okay, and Joe, that would put the next person
Yeah, it's the right thing to do.
right in with that, with
Yeah.
Alice.
It makes
Okay.
it makes a lot of sense.
Is 4 years enough?
Yeah,
The
you guys-
last one was 5 years.
And we're not asking for a decision today since it's not on the agenda.
Oh.
We are asking
but it
you
will
to
be
start
soon.
thinking about it because at your next
meeting.
we may
45.
want to have something, but getting general direction from you
Right.
would allow us to formulate a staff report for your next meeting that, has a recommendation to, negotiate an extension or a new contract.
Okay, so I was HR, so I get nervous about this thing. So by the time we have our next meeting, Joe's going to be gone.
Yes.
Yeah.
February.
What if we get someone in that doesn't agree with that direction and we don't have a meeting until after Joe's gone?
We can call a special meeting.
Thank you. That was what I wanted to hear from you, that we call a special meeting fairly
And
quickly.
they'll still
Joe,
be
I know,
observations, so
you know
part of
you
the
think it's,
recommendation will be
yeah, I think it's going to be fine, Joe, and it will be, but
Double secret.
I think but I think it makes sense that for staff and to work on a RFP, it takes a lot of lead time. And we have
we don't
so
want an
few
RFP.
meetings.
No RFP.
That's really what we're saying. If you say no RFP, then everything's good. The next report will be a discussion about this is what we're doing in the renegotiation.
yeah, just renegotiate it.
Yeah, and then
Totally.
you'll be asked to give explicit direction. So our lawyers pleased, explicit direction to renegotiate. Right now, you're just sort of hinting at it.
Got it.
Yeah,
I'm not hearing any opposite.
I agree with Mark.
on the hinting.
Can I ask one question? 'Cause I am used to that model where you had kind of the distinct investment manager overseeing some of the work that was going on, and I know that we hesitated and we looked into it and we got the legal opinion and everything else, and it seems to be going well. I just want to make sure as we go forward with that model that we have some sort of additional safeguards maybe in place or something to look at, and how that comes out in whatever the negotiations are. I leave it up to you guys.
Or you could decide theoretically that you want to keep PFM, except for you want to hire a new replacement for the prior, trustee that held the assets.
Yeah.
I'm just cynical enough to think and paranoid enough to think that a large bank corporation might slowly start to shift little things that may end up being big things down the line. And
I would recommend then that your next meeting or the one after, your next meeting, that you could talk about that. You put that something on the agenda and get a refresher about what the structure is, because Ensign Bridge has spent a lot of time reviewing the structure And I think it'd be good to bring that back, and you guys could educate the board again on that structure, and then you guys can make a decision what you want to do. You know, PFM is also your fixed income investment arm, right? They do that job too. We use a different bank. It's not the same custodial bank. Different bank.
Just an old curmudgeon used to.
Yeah, it worked out that way.
Wow.
You know? Yeah.
So at the next meeting, we'll have a discussion about this topic about, do you want to have a separate custodial bank?
Yeah.
Going
And
forward and just keep PFM for what they've been doing all along.
Right. And
We'll give you pros and cons of it.
Yep.
I think it's good.
Yep.
Good managed. Good fiduciary duty on our part. We have to take a vote on this particular item. Are you,
Second.
Alice, are you done?
Yes.
Yes. So I have a motion and a second, and voice vote. Since there's no public comment.
That's right.
All those in favor, please say aye.
Aye.
Is there anyone opposed? Please say no. Hearing no opposition, that does pass. Unanimously.
Yes. See, you didn't have one.
Yep.
I'm just
That
curious.
leads us to number 9, and that's the next OPEB Retirement Investment Trust Board meeting, which is scheduled for March 27, 2025. That'll show up on the calendar once the full order actually approves the full 2025 calendar. We'll make sure to add it there. And that's again, March 27, 2025.
Great.
March.
Thank you.
We'll invite Joe back on March 2025. I'll send you the specific meeting invite.
you know,
Seeing no other public comment, we then are adjourned.
That's right.
Well, that was easy.
Well, we're going to see you all on March 27th.
and,